Welcome to the daily update, where I'll go over the action in the market from Monday, February 10th, and we'll see how things look for Tuesday, February 11th. We had an up day, not an awful lot of conviction. Most of the gain really came from the gap, where for the first time in 3 weeks now, we've seen an actual positive gap. The last two Mondays saw a pretty significant gap lower, where in Monday's session, we actually gapped a little bit higher. And after the open, we maintained that positive stance. We saw a little bit more buying, but didn't get up to R1. We fell back a little bit, didn't really see an awful lot of selling into strength, and then we were able to go back higher and close pretty much near the high for the day. Now, we are still positive when you base things around moving averages. There are some internal indicators that we're looking at that are showing weakness, but at the same time, our smart money indicators continue to be quite strong. Our growth to value ratios are holding up quite well. Discretionary to staples is looking pretty good. Not great, but I'll go through and show you those charts. Okay, so right at the open, we did have a higher open right at the daily pivot at 6,049. We're right around that 6050 level, and that's, of course, halfway in between 6,100, the resistance that we hit in Friday's session, but still above 6,000. So we did rise up after the open, but we didn't get to R1, which was at 6,078. Then we did pull back, but it wasn't real intense selling. We just saw kind of drifting lower, and we didn't quite get back down to the daily pivot. And then we chopped higher going into the close and closed at the intraday high. We were up 0.67% on above average volume. And we are still positive in the short, intermediate, and long term. We're seeing areas of weakness, but when we have an up day like we saw in Monday's session, now things are tilting a little bit more to the improvement side. Interest rates were virtually unchanged. They rounded it down to 4.49% after Friday. Well, we had to round it up to 4.49% in Monday's session. And a lot of this is kind of going on with the background of, okay, there's these confirmation processes that are going on with the new administration. There's the executive orders, there's these statements coming out, and that's causing some confusion for right now. And of course, we had the Super Bowl. Well, that's finished now, and nothing in a negative way other than how the Chiefs kind of collapsed. Nothing real catastrophic happened. At least nobody, there were no attacks. There was nothing really crazy that happened that way. Um, so that's done now, and now we're just trying to work through this process of, okay, what's this going to do to inflation? What's this going to do to corporate earnings? That's how it impacts the stock market. Okay, so some comments that we can make. President Trump did announce new 25% tariffs on steel and aluminum. Okay, have another little chart later on that may break that down just a little bit. Mega caps had a good day, and that's why the indexes were able to maintain their gains and look more solid. We're still under 4.5% with the 10-year yield. And then on a short-term basis, we're still extreme with the short-term slope oscillator, but it's kind of right on top of its moving average. Now it's going back up a little bit with the up day, where it had been declining overall, but it's still dealing with that moving average. And then our three smart money indicators, accumulation distribution, chicken money flow, and chicken oscillator, those are looking extreme, but that doesn't necessarily mean they're positive. It may, or extreme positive. It's not that they're going to go up like some of our oscillators where we hit an extreme reading turn and then go the other way, and that suggests a reversal in the market. This is just showing, yeah, the smart money's coming in and doing some buying, and these ratios continue to improve, and that's under the surface strength that we're seeing. No changes to the current scenario. And it looks like the market, as well as the Fed, is still anticipating a soft landing, meaning that we will not go into a recession, but that can change. That's why we watch all these different charts, but it's not going to change overnight. It's not, oh, we get one thing that goes into the recessionary direction. Everybody freaks out. Everybody talks about it. The market overreacts. No, we take a step back approach and say, okay, what is the data telling us over a longer period of time? The dollar was up, interest rates were up. As I said, we closed at 4.49%, rounded up after Monday's session. We're still negative, and we're drifting up slowly into that neutral area as far as sentiment. We closed at 46, where we had been at 39. And we're not trending. And that's what's causing this real choppy environment. The ADX is picking that up. It is positive. Now, the charts, it they look a little bit more negative when I go to show you the charts, but they're actually positive, and I'll explain what I mean when I get there. And because of the up day, our bias is positive, and I'm still keeping our momentum at mixed because of the chopped environment. We didn't really have any official economic reports in Monday's session, and we did get the New York Fed survey of consumer expectations, where it said that they remain stable. 1 and 3 year projections are unchanged at 3%, but 5 year projections, looking at inflation, are up 0.3% to 3%. So there's a general consensus that inflation is going to creep back up now in what we're seeing. Okay, then Isabel Net. Now, here we go. If it moves, if it exists, if it's a competition, they create an indicator around it. So Super Bowl blowouts are what Bulls should be cheering for. So even if you're a Chiefs fan, with your investments, you might want to continue cheering here. When there's a 21 point difference, um, the average return is 3.6%, with the median being 14.6%, and we're positive 84.6% of the time. Okay, all right. Equity positioning still coming down a little bit here after being really extreme with those stock positions. And then strengthen the S&P 500 CapEx, that's capital expenditures growth, but weakness in buyback growth. Okay, so companies, instead of going out and buying their own stocks right now, they're taking that money and investing it back in the company itself. So we're seeing a real increase in capital expenditures, a bit of a drop off here with research and development. Dividends, this is what goes out to shareholders. That's increasing a bit. But then the buybacks, at least to this point, have been dropping off when we look back over the fourth quarter. And then this is the sector valuations relative to history. And I'm not going to go through all these. I usually break these down in the weekend videos that I do, where we look mostly at the PE ratio just for the S&P 500. This breaks it down according to their 11 different sectors on whether they're considered to be expensive or inexpensive or fairly priced right now. And gold price, of course, a lot of the perma bears out there, they're always projecting things like this. But this is Goldman Sachs. They think we're going to go up above that 3,000 level with gold. And then this is another one you may want to pause and look at. This is what were the returns like, and then what were the drawdowns during those years. So this is where we're up about 3% right now, and so far we've had about a 2% drawdown or decline on the year. And this just kind of takes this and looks at it, and you can see that in a general sense we have lesser drawdowns when we have higher gains, and that should make some sense. And mega cap growth and tech positioning also still getting up here kind of high. We're still under this purple line, but this is where most of the money continues to go. And then this breaks down the steel and aluminum a little bit more, and we get a lot of our steel and aluminum from Canada. And so that could really increase the prices that's coming in from Canada. But at the same time, the goal here is to, okay, instead of getting our steel and aluminum from other countries, let's build it let's create it and manufacture it in the US. And that's the ultimate goal here, at least the reason for doing this. And then the third year of a bull market tends to be messy. I don't know if I would call this messy. It ends up being more flat, where we have year one, year two, and then we don't necessarily decline, but this can really slow things down. And then new highs are muted on top, new lows are muted on the bottom. And then this is the 11 sectors again, and then the number of stocks in that sector and those that are currently making 52-week highs. And then down here, the number that are making 52-week lows. And we're still seeing where new highs are outnumbering new lows overall. But this breaks it down according to the sector, whether we're looking at growth areas, whether we're looking at more defensive areas, or those areas that are more driven by is the economy looking better or showing some weakness. Here's our intraday chart where a lot of the gain came from right from the gap. We opened up at the daily pivot, came up here, didn't get up to R1, fell back, didn't get down to the daily pivot, kind of drifted our way back up and closed not too far off of the high for the day. Not a real day of conviction as far as price movement. And we're down a little bit here in the initial overnight session. Looking for Tuesday session here. This is still looking positive with the blue line above the red line. That means intraday growth is outperforming value. This continues to improve going back to the latter part of January. The S&P intraday growth to value ratio is still going up. End of day growth was up quite a bit more than value, where it was up, but up less for the mid caps and down for the small caps, where small cap growth to value was up. So here's the small cap chart, still looking pretty good with the growth to value ratio here. Mega caps looking a little better. This has been breaking out lately, and it's not being reflected in the index, but we are seeing it under the surface with the growth to value ratio. And we're still improving here with the S&P growth to value ratio. Not really breaking out and setting a new high, but this is under the surface showing some buying that is going on. Not much of an improvement here, other than we were up over 0.5% with this ratio between the growth and value ETF, but we're still inside the rainbow. This is lagging a little bit behind what we're seeing in other charts. Discretionary to staples, not really doing great in Monday session, but still overall holding up quite well. We're still above the 50-period moving average with large cap growth. Our trend continues to show where the ADX is going down below the moving average. And this is what I was talking about. It looks like the green line may have crossed below the red line, but if you come over here and look at the numbers, which may be hard to see, the green number is still higher than the red number. So this is still being treated as positive. And also, the green number is higher than the red line here with the short-term chart, even though it looks like it may be crossing down below. But we're just not trending. We're just keep going down in the short and intermediate term. And we're also not trending on the weekly chart either. And we're below the moving average. And volume did drop off just a little bit here. Sentiment, not much of a change here with the VIX, both on the line chart as well as the bar chart. Right about at the moving averages with the VIX of the VIX, as things are kind of subdued right now. And we're pretty much flat with the MACD. You might make a case that we're a little bit below the moving average, but we're just like with the trend that we're seeing right now, we're just floating sideways. Still getting a high reading with the skew index, but we've been seeing that now for quite a while. We ticked down with this fear gauge and also ticked down just a little bit with this other fear gauge, but not much of a change. And this is looking at insider transaction ratios, purchase or sales that are legal. And it is coming down, and we're getting back into this more neutral area. And so when I look at that chart, I also bring up the insider buying ETF, which has pretty much gone sideways since about late winter 2024. And I go over this in the weekend video. This is the weekly individual investor survey where they dropped more negative in their recent poll. And we declined with this fear gauge. The equity put call ratio daily chart, we're declining now with the 5-day chart, and we're down in this extreme area. And we're now back to declining with the 10-day chart. So those are confirming each other that fear is coming out of the market. We ticked up a little bit, but we're still at the lower end of the range with the volatility risk premium. So not a real significant increase in fear here. And we're still going down with the 5-day, and we're back to going down with the 10-day. We're dropping off with the new highs. Not much of an expansion of the new lows, but they are more than what we had been seeing recently. And so this is a little bit of a concern with the internal structure of the S&P 500. We would like these lines to go back up. And we're doing okay with the advanced decline line based on price and volume. Ticked up a little bit with both, and we're above the advancing moving averages. Ticked up a little bit with our advanced decline ratio for the short and intermediate term. We're still above zero. This is smart money indicator number one. We ticked back up. Now, you could make a case that we're getting kind of far away from the moving average. And we went back up with the histogram with smart money indicator number two, the chicken money flow. That's positive. But again, this is sometimes an extreme reading area. And we're still going down though with the chicken oscillator. It came back up a little bit and it's not picking up a lot of strength currently. We declined, but we're still positive with the vortex. The advanced decline line studies still above the moving average with the NYC common stock, S&P, and the mid caps, where we were pretty much flat and below the moving average with the small caps. Ticked up barely here with the 20 period moving average study of those stocks inside the S&P, and we're still above 50, so that keeps it positive. And we're just barely above 50 with those stocks above their 50-day moving average. And we went back to being positive with the 100 period moving average study after we dropped slightly below 50 after, or excuse me, yeah, below 50 after Friday, and ticking back up barely here with those stocks above their 200-day moving average. And here we go with the daily chart here. We're still well above the 50-day moving average. We did drop down a little bit below average with volume. I had it as above average, but that should have been below average. Ticked up a little bit with our 20 period moving average, but we're still flat to declining with the 50. Turned up a little bit here with the 200 period moving average study. We're no longer extreme with the Stochk RSI. That improved slightly, but our short-term indicators are just kind of floundering around here, not really showing any conviction. The Williams percent are, the CCI 14 and the CCI 20. The stochastics just kind of floating around, not giving us any kind of extreme readings currently. Slightly positive with the force index. The condition of the short-term trend measured by 20 periods, we're still pretty much going sideways with these lines, but we're still above the simple and exponential moving averages. That's why we're positive in the short term. Slightly above the midpoint with the standard deviations chart. That's leaning a little bit more positive now. Still declining, but very positive with the balance of power after it had been extreme positive. Still positive with the go, no go with the darker blue bars. Still above the midpoint here with the highest high value charts. And still showing some weakness though with the TTM squeeze. Darker blue and declining. And dropping a little bit negative here with the ease of movement. That just means the path of least resistance was pretty much neutral now and actually turning a little bit more negative. And ticking up, but still negative with the S&P McClellan oscillator. So we're starting to come over based on price, and we're starting to flatten out now a little bit based on volume. And this is what you see in a non-trending environment where these two don't necessarily line up with each other. And after being just very, very slightly, I'm not sure how to say that, slightly negative with the NYSE McClellan oscillator, now we've gone back to being slightly positive. And still kind of going up here with the summation index based on price, going flat with the summation index based on volume for the NYSE, flat with the Arun indicator, but still positive. We are seeing an improvement here, possibly. The Swenlin trading oscillator based on price and volume are both turning back up, and we have volume crossing back above zero. Momentum just barely hanging on to being positive here with the PMO, where we're coming down to the moving average based on price. We're pretty much on top of the moving average based on volume. Ticking back up, but more neutral now with the PMOs that are rising. The buy signals continue to decline, and we're slightly going up here with those PMOs that are above zero. And we've gone from negative back to positive here with the Elders Impulse system for the S&P. We're still negative with the parabolic SAR, and we're declining here with the slope oscillator, but we're still getting an extreme reading and coming down and just about at the moving average with the MACD. So our oscillators looking a little more negative in the short term, rolling over but not turning negative quite yet in the intermediate term, rolling over but still positive in the long term. Where the copy curve, another momentum oscillator, that is now, we're seeing it for the second day negative. And Sean trend meter still looking positive, and we're still above 50 with the money flow as well as the ultimate oscillator. Still above the moving average with on balance volume. Still above 50 with the RSI 14 and 9. This could be going away now. The Pring bottom fisher, we're crossing below the red line here. So the signal was actually generated back in January and actually kicked in a little bit before we bottomed out and went up. And that was ended up being a pretty good signal. Now, if you're more short term, you like that. But lately, we've just been chopping around sideways. The condition of the intermediate term trend measured by 50 periods, slight upward bias as the blue line and the red line continue to go up. And we're above the 50 period simple and exponential moving averages. We're above all the plotted moving averages here. So that's why we're positive in the short, intermediate, and long term. And we actually declined a little bit with the bullish percent index. We had a down day on Friday, but a positive open, and that helped the BPI to improve. Well, we had a positive open and an up day on Monday, and the BPI went down. So not quite enough to turn it negative. It hasn't dropped below its moving average, but it did decline. Where we're still just showing minuscule changes here with the NYSE bullish percent index. And after coming up to the 70 level, we declined slightly, but still positive with the NASDAQ 100 bullish percent index. And showing that we're still above this little mini rainbow here. If we do see more of declines, then we will be watching one of these levels for possible support. And you notice this was an inside day where Monday's session did not exceed Friday's high or Friday's low. That can show a little bit of indecisiveness for the market and that we're going sideways in a non-trending environment. This is longer term where we're still hitting the upper end of this trend channel going back to 2009. We've been watching this for many days now. This is another look at that same basic idea, only it's going back to 2022 here and just suggesting that we're not trending right now. We've been in a plus to minus 2% range over the last 3 months. But usually, what will end up happening is when we do chop sideways, when we break out to the upside or to the downside, that usually means there's more conviction behind that move. We just don't know how long this is going to last. And it's still looking pretty positive here with the Heiken Ashi, but the bars are not really moving all that much. We're negative but pointing up with the Kegi chart. We're positive with the Renko chart. We're positive with the three-line break chart. And I didn't bring up the long term right now because we're just fighting to get through the short term currently. So we're positive across the board with all the different stock indexes that we actually, these are across the different markets that we look at. Still negative with bonds in the intermediate and long term. These are the stock indexes, still negative with the mid caps in the short term, where all the other indexes are positive on all different time frames. And we had healthcare and financials down. Now, financials we'd like to see doing a little bit better. Healthcare is more defensive. But then all of the other areas ended up being positive with energy, which has really been getting hit lately. That ended up performing the best. Tech and communication and discretionary. Not any real gangbuster day, but they were still positive. And we saw some positive signs right here with the NASDAQ getting above 19.6, but then it was able to also climb above 19.7. We had a bearish MACD crossover with the Dow, and discretionary had a BPI cross above 50. That's been getting hit lately. If this area can continue to improve, which is kind of a growth area, that would really help things. Not much of a change here with our weighted versus equal weighted version of the S&P. The Dow just kind of floating along sideways. The diamonds have gone from negative to neutral with the Elder's Impulse system. We're slightly back above the 50 period moving average with the NASDAQ and the NASDAQ 100. And we've gone from negative back to positive with the Qs, looking at the Elder's Impulse system. The momentum turning up just a little bit, but we've been pretty much flat here, looking at the NASDAQ 100. And here's the small caps, just still below their 50-day moving average, virtually unchanged on the day. And actually down with the Russell 2000 small cap index, but still below its 50-day moving average. And negative to neutral with the small caps. Mid caps virtually unchanged, still hanging out about at this pivot point, but below their 50-day moving average, and still negative with the Elder's Impulse system for the mid caps. The Wilshire broad market measure still above its 50-day moving average, and we're still above the 50-day moving average with the total U.S. stock ETF. Financial sector was down, but still looking pretty solid there. The FANG index was up over 1.5% above its 50-day moving average. These are the really big stocks. Microsoft, which continues to be down below its 200-day moving average, it was up 0.6%. Apple, not much of a change there, above its 200-day, but below its 50-day moving average. Amazon was up 1.74%, still looking in a solid uptrend there. Google still dealing with its 50-day moving average. It dropped below in Friday's session, and it still hasn't been able to get back above that. Meta was up 0.4%, still looking pretty solid there. Tesla, below its 50-day moving average, declined another 3%. Nvidia up 2.87%, now coming back and trying to test its 50-day moving average. Netflix was up 1.35%, hitting a new all-time high there. And not really much of a change here with the US versus world stocks here on a short-term basis, and we're flat with the longer-term correlation. Oil did go up. We're still in the lower end of the 70s, though. The dollar was up, bouncing up off of its 50-day moving average. And we were up just a little bit here with the 10-year yield when you round it up. And I've been watching the intraday chart of the 10-year yield, and we're still below that 4.5%. We got a little bit above it, and then we dropped down below. And then this could be acting as overhead resistance. So we're going to be keeping an eye on that. And we were virtually unchanged with the 7 to 10-year ETF based on price. Keeping an eye on the 10-year yield in Japan, it continues to go up. And is that going to cause a problem like we saw last summer? And looking okay here with the Qs to S&P. Where we're seeing some weakness right now is discretionary to the S&P. And we're a little bit under the moving average with large cap growth versus value. So we're under the moving average with the large caps. Mid caps looking pretty solid here, ticking up slightly above the moving average with the small cap growth to value ratio. So what's our outlook for Tuesday? We're positive, and I should have changed that. I did later on, but the takeaway here is that we're not trending for the time being. We will get the NFIB Small Business Optimism Survey, and then all the different things going on. And take your pick. Whether you love what's going on or you hate it, it's a confusing time right now, and you've got people forming opinions, both positive or negative, where you don't really have complete information on what's going on. But that never stopped people before. Okay, and then we're going to get a big report on Wednesday, CPI, then we'll get PPI on Thursday, retail sales on Friday. Here's a look at the calendar. And I think I misspoke over the weekend. I thought it was Monday when Chair Powell was going to testify. It's actually on Tuesday. Okay, seasonality neutral to positive for February 11th. Not much of an edge here. And we're still dealing with the first half of February, which tends to perform better than the second half. And the first quarter, February, tends to not perform all that well during a post-election year. And here's the first half of February with the second half of February. This is the quarter chart here. It's the, no, here, we're another monthly chart. Okay, I'm trying to get ahead here. The post-election February tends to be the worst performing time. Small caps not doing all that well, and I guess I took out the quarterly chart and kept wanting to talk about it anyway. The parabolic SAR is still negative, as is the S&P McClellan oscillator, and the summation index is turning down slightly, even though it's kind of hard to see, but we've been declining based on price. The Copic curve is negative. The ease of movement, that's a new addition to the negative side here. And this mass index, I'm kind of leaving that behind because we've been getting beyond where that signal actually applied. Then on the positive side, still looking okay with our smart money indicators, but we're a little bit concerned here about the Chaikin oscillator. It's not really showing much of an improvement. Growth to value and discretionary to staples are still holding up. The 5 and 10-day equity put call ratio charts are going down now. That's positive, or they were going up after Friday. The advanced decline lines not really showing a lot of strength, but we mainly focus on the S&P for that. And notice I didn't show any of the advanced decline lines for the other indexes. We're just chopping along sideways right now. And we're still positive with the NYSE McClellan oscillator and summation index. The oscillators kind of starting to look a little more negative in the short term, but we're still positive but declining in the intermediate term. So it's just showing that we're not going anywhere right now. The bullish percent indexes are still positive, even though we declined with the bullish percent indexes, but they still are above 50, and the context is that they have been improving. The vortex is positive, and the Swenlin trading oscillator, that's back on the positive side here. We're turning back up based on price and volume. The money flow and ultimate oscillators are positive. Our moving average studies still looking pretty good there. We're above 50. We ticked up just a little bit. Financial sector is positive, and the momentum for the NASDAQ 100 is positive. So our conclusion, we're positive, but we're not trending. We now, with the slight update, we are showing signs of improvement, and the smart money indicators are looking positive now, but declining after being extreme positive. But some of them showed some improvement in Monday's session. We're not trending, and the smart money indicators. We're keeping an eye on this just because they're two of the three are kind of extreme right now. And we're not trending in the intermediate term, but we are still positive, and we're still we're leaning a bit more towards the improvement side, but the weakness hasn't really been overcome yet, where we are still positive in the long term. So thank you. Have a really good day on Tuesday, and I will talk to you in the next video.